The Indian stock market has experienced a 7% rebound after a steep 16% correction since September 2024. Foreign institutional investors are coming back, joining the surge of retail and domestic institutional buyers. But here are $1,000,000 questions. 1. Is this a start of a bull market in India? 2. What are some macro factors that could positively or negatively impact the market? 3. What are few stocks to buy for long term, and what should be our strategy given uncertainties in the Indian and global markets? Don't miss to watch the segments on macro factors and strategy to build positions in these uncertain times before jumping into specific stocks. Let's dive in. Hey there, I'm Palani, a technologist turned investor and an early retiree. I share my experiences from 20 plus years of investing in US and India. I am not a financial advisor. Investing involves risk. Do your own research before investing. Without further ado, let us jump right in. There are so many macro factors in play both in India and global markets. Let's take a look. First, on tariffs. There are quite a bit of uncertainties across the globe around the US tariffs and its potential impact on countries like China, India, Mexico, Canada. Any adverse reciprocal tariffs to be announced on April 2nd could negatively impact the Indian market. Number 2. Inflation is currently hovering around 3% in US, and there are concerns that inflation may rise further due to new tariffs. In addition, US dollar has weakened about 3.7% in the last few months. So these uncertainties in US are forcing US institutional investors to look for alternate markets like China, India, and other emerging markets like Vietnam. There is a favorable macro trend for India. 3. The China plus one strategy is still in play, and countries like India, Mexico, and Vietnam stand to benefit in a number of different sectors. 4. There are multiple factors that resulted in correction in India starting September last year: slowing GDP growth, weak corporate earnings, and high market valuations. So we need to wait and watch how Q4 earnings look by April-May before going all in. Last one being job losses in the IT sector and slowdown of this industry may impact consumption in India. So given all these macro factors in play, how do we tread the market? Let's see. First, don't go all in the given uncertainties. At the same time, don't miss the opportunity to invest in small chunks in good, fundamentally strong businesses given recent corrections. It's about finding the right balance. Second, there is a possibility that market may be moving on the sideways, consolidating until June, waiting for corporate earnings and the outcome of US tariffs. As you know, no one can time the market. If you plan to buy a particular stock, say 100 stocks, buy lots of 10 spread over a period of 5 to 6 months. This way you can DCA on the way down and start adding on the way up. Time in the market is more important than timing the market. We are in the market for making money. Never lose your capital investing in FOMO or speculative stocks. Lastly, think investing in stock is like buying a property and letting it compound over years. Never invest any money in stock that you need for your expenses in the next 5 to 10 years, because no one can predict what will happen in the market in the next 1 year or next few years. Have a long-term perspective. Now let's jump into specific stocks. First one is Indian Energy Exchange. IEX is India's premier electricity exchange with a huge 85% market share. Think IEX like a stock exchange. Here, state governments and private companies buy and sell electricity. With a growing economy like India, there is going to be a huge demand for power. I like IEX because it has monopoly in this space. It is asset light with a high operating margin of 85%. Both FIIs and domestic institutional investors have been buying for so many quarters, and it is in the threshold of moving from small cap to mid cap. Next one in our list is Sundaram Finance, one of the reputed NBFCs focused on retail financing across multiple domains like vehicle finance, home finance, mutual funds, general insurance, and financial service distribution. Foreign institutional investors have been buying consistently the stock from December 2023, increasing their stake from 8% to 18%. Interest rate fluctuations in India may have some impact on this stock. Third one is Bharat Petroleum Corporation Limited. BPCL needs no introduction. This oil and gas giant has a well-diversified product portfolio covering refineries, retail gas stations, LPG, industrial products, aviation, on and on. Low P/E compared to HPCL, Indian Oil Corporation, is a great thing. This is a cash-generating machine and pays a dividend of 5.5%. Any oil price fluctuation, policy changes could impact this stock. Fourth in our list is Hindustan Aeronautics Limited. HAL is a key player in India's defense sector with strong government contacts and focus on Make in India. Many European countries are ramping up their defense spending after the Trump administration's NATO pushback. The Indian defense sector is standing to gain some pie of the European spend too. Stock is reasonably priced at a PEG ratio of 1.17. It has a double-digit sales and earnings growth at 14 and 40% respectively. FIIs have increased their stake starting December. This is a long-term play. From a risk perspective, it has huge dependence on government contracts and policy changes. Considering geopolitical situations with neighboring China and across the globe, India's defense spending is not going to slow down in the near future at all. Fifth one, KFin Technologies Limited. This is a leading technology-driven financial services platform. The company provides services and solutions to asset managers, mutual funds, and corporate issuers across India and globally. Fintech services 26 out of 48 Indian mutual fund and AMCs. KFin has a high sales and earnings growth at 30 and 40%. FIIs have been doubling the stake in KFin since December 2023. As mutual funds and AMCs pick momentum in the years to come, KFin Tech stands to gain. Sixth one in our list is from auto industry, Mahindra & Mahindra. M&M is one of the most diversified automobile company in India with presence across two-wheelers, three-wheelers, CVs, tractors and earth movers. Strong rural demand, EV expansion plans make it a good long-term position. Revenue and the earnings grow at 10 to 15% CAGR in the auto and farm segment. Competition in the EV market, global chip shortages and any potential tariffs may impact this stock negatively. CDSL, one of the leaders in depository business, benefits from increasing stock market participation. CDSL facilitates holding and transacting securities, the stocks that we buy and sell in electronic form, and facilitates the settlement of trades executed on stock exchanges. It's another asset-like business, and revenue and earnings are growing at over 50%. CDSL missed numbers in the last quarters and took a big beating, so it is a good time to enter. At the same time, given the turbulent market scenario, the stock could have some volatility in the short term, but it's a good long-term play. So there you have it. a comprehensive look at the current state of the Indian stock market. We have explored the recent rebound, potential macro factors, and the investment strategies. Remember, the stock market is always unpredictable in the short term, but with discipline and long-term perspective, you can navigate these uncertainties and compound your wealth. What do you think about the current market situation? Do you see a bull run on the horizon? Are you more cautious? Share your thoughts in the comments below. If you found this video helpful, give a thumbs up, like and subscribe to our channel for more market insights. Thanks for watching, and here is to making informed investment decisions.